Please enjoy the recent event. Subscribe. Silicon Valley Bank had a long and illustrious history that spanned over 4 decades. The bank, founded in 1983 by Bill Biggerstaff and Robert Meteris, had weathered the dot-com bubble and helped fund over 30,000 startups in the years that followed. But despite its long history, the bank was not immune to the recent turmoil in the financial sector. The bank was headquartered in Santa Clara, California, and was the biggest bank in Silicon Valley based on local deposits, with a 25.9% market share as of June 30, 2016. The company focused on lending to technology companies, providing multiple services to venture capital, revenue-based financing, and private equity firms that invest in technology and biotechnology, and also on private banking services for high-net-worth individuals. Silicon Valley Bank was also an S&P 500 index member and had several offices worldwide, including in India, the United Kingdom, Israel, Canada, China, Germany, Hong Kong, Ireland, Denmark, and Sweden. The bank had been through several ups and downs, including a merger with National Intercity Bancorp in 1986, an IPO in 1988 that raised $6 million, and the opening of several new offices throughout the United States and worldwide. In the mid-1990s, the bank had provided early venture capital to Cisco Systems and Bay Networks. However, in 1992, the bank was hit by the real estate burst, which accounted for 50% of the bank's assets, and recorded a $2.2 million yearly loss. The bank's founding CEO, Roger V. Smith, was replaced by John C. Dean, and Smith became vice chairman of the bank. Smith left in 1994 to launch the Smith Venture Group. In 1995, the bank moved its headquarters from San Jose to Santa Clara. Despite the setback, Silicon Valley Bank continued to grow, expanding its private banking business in 2002 and opening international subsidiaries in Bangalore, India, and London in 2004. In 2005, it opened offices in Beijing and Israel. The bank began operations in the UK in 2006 and opened its first branch there in 2012. By 2011, the bank had helped fund more than 30,000 startups. In December 2008, the bank received a $235 million investment from the U.S. Treasury through the Troubled Asset Relief Program. The U.S. Treasury received $10 million in dividends from Silicon Valley Bank, and in December 2009, the bank repurchased the outstanding stock and warrants held by the government, funding this through a stock sale of $300 million. In November 2012, the bank announced a 50-50 joint venture with Shanghai Pudong Development Bank, SPDB, to provide capital to startup technology entrepreneurs. In July 2015, the joint venture was approved by the China Bank Regulatory Commission, CBRC, to operate in renminbi, RMB, the official currency of the People's Republic of China. This license allowed the joint venture to provide banking products and services to its clients in local Chinese currency. By 2015, Silicon Valley Bank was providing banking and financial services to 65% of all startups. In March 2017, Michael R. Desaneaux was named president of the company. However, on March 10, 2023, after a bank run on its deposits, Silicon Valley Bank suffered from bank failure and was taken into receivership by the Federal Deposit Insurance Corporation in the second largest bank failure in American financial history. On Friday, California state regulators closed Silicon Valley Bank after deposit outflows and a failed capital raise plunged the country's 16th largest bank into crisis. The FDIC was appointed as receiver, meaning it would be able to sell off assets and return money to insured depositors. The bank had $209 billion in assets and $175.4 billion in deposits, making it the largest bank to fail since Seattle's Washington Mutual during the height of the 2008 financial crisis. The news sent shockwaves through the banking industry, with shares of other regional banks also plunging. Signature Bank, a New York institution that serves some cryptocurrency clients, saw its shares drop over 16%, while First Republic Bank, which serves companies in the venture world and high-net-worth clients from the tech industry, saw shares fall as much as 40% early Friday. Many investors were increasingly concerned about how banks, especially smaller ones, would fare now that the Federal Reserve was aggressively raising interest rates. Banks were being punished if they had any perceived exposure to problematic customer bases or large amounts of bonds that could produce losses if banks were forced to sell them. The recent problems at Silicon Valley Bank started with the Fed's campaign to bring down inflation, which pinched many of its startup and tech clients. An outflow of deposits forced the bank to sell assets, bonds, at a loss. Banks needed lots of safe places to park their cash, and bonds had been an attractive option during a period of historically low interest rates that spanned the early years of the pandemic. But now the Fed was hiking rates at a rapid clip, with Fed Chair Jerome Powell warning earlier that the central bank may have to speed up the increases to cool the economy further. The move had sent shockwaves through the financial sector, and many investors were left wondering which banks would survive the tumultuous period ahead. As news of Silicon Valley Bank's closure spread, investors scrambled to assess the damage. Shares of the bank's parent company, SVB Financial, were halted for trading after having lost 60% on Thursday and another 60% in pre-market trading on Friday. SVB was now seeking a buyer and hoped to complete a deal by Monday, according to a Bloomberg report. Treasury Secretary Janet Yellen acknowledged the industry turmoil on Friday, saying there were a few banks the department was closely watching. When banks experience financial loss, it is and should be a matter of concern, Yellen told lawmakers. The FDIC, which serves as a backstop for deposits at U.S. banks up to a limit of $250,000, said all insured depositors would have access to their funds no later than Monday morning. Roughly 87% of Silicon Valley Bank's deposits were uninsured as of December 2022, according to its annual report. Uninsured depositors would receive an advance dividend within the next week and a receivership certificate for the remaining out of their uninsured funds, the FDIC said. It could make future dividend payments as it sells Silicon Valley Bank's assets. As the financial industry struggled to come to terms with the news, it was clear that Silicon Valley Bank's collapse would have far-reaching consequences. The bank's rise and fall mirrored the broader challenges facing the industry, and investors were left wondering what would come next. Thank you for watching. Please subscribe for more.